Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Monday, March 23rd, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. We were down 2.93% today on the S&P 500 and closed at 2237.40. What we're looking at here is a 2-day, 2-minute chart. So each candlestick represents 2 minutes of trading in the S&P 500. And the reason I wanted to start with this chart is to just show you what has happened over the last 2 days. And we continue to backslide and backslide. And also, of course, Friday was where we closed for the first time beneath the 2350 level, which is why this blue line is here. And that 2350 level, as you'll see on another chart, represents where we started the last leg of the rally, where we bottomed in Q4 of 2018. And so breaking beneath that 2350 level was very important. And as you can see here on today's trading, we traded beneath where we closed and beneath the lows that we saw on Friday, the 20th. And so this dotted blue line represents where we closed on Friday. And as you can see, we gapped down at the open and there was a lot of volatility, and we tried to get, and we got right back up to where we closed on Friday, right here, and just could not get above that. But when we move to a 1-day, 1-minute chart, so this is just today, guys, and just look at the volatility here. And to put this in perspective, from where we hit our lows around 11:45 this morning until we got up to right at this, and you can see just for a second, we kissed this 2300 level. That is a 4.9%, almost 5% intraday move. And of course, we backslid and bounced a little bit and closed not at the lows of the session, but kind of towards the low end of the range. Again, down 2.93%, closing at 2237.40. Now, when we pull back to a longer-term chart, and what we're looking at here is a 7-year chart of the S&P 500, where each candlestick represents 1 week of trading in the S&P 500. And you can see here that this now is going to mark the second week, at least the start of the second week, below this 2350 level. Again, that's where we bottomed in 2018 for this last leg of the bull market. And you can see here at this point now at the 2237.40 level where we closed, we're clear back into 2016. So we have erased all of the gains that we had from 2017, 2018, 2019, and the first part of 2020 at this point. And the next level that we're going to find ourselves in on the way down here is somewhere between this 1900 and 2100 level on the S&P 500. And of course, there was about 2 years of trading in this range from mid-2014 until mid-2016 when we finally broke out of this range and then, of course, pulled back to the top of the range, fairly normal there. You do a check back, and then the real rally begins. So, we're on our way down to this level, guys. It's just a matter of, is it going to be a few more days or a few more weeks? Will we get some type of a rally here? Will we get a rally attempt to try to get back over this 2350? It's completely possible, but it would take an absolute miracle at this point for us not to get down to this 2000 level, plus or minus about 125 points. Hopefully, once we hit this 2000 level, it will start to provide more technical support for us and slow down the rate of degradation, slow down the rate of decline of this ravenous, this relentless bear market. Now, to put this in perspective, guys, once we get down to this 2000 level, from where we peaked at 3386.15 just a month ago, just back on February 19th, once we get down to this 2000 level, that will represent a 40.94% decline. Again, from 3386.15 down to 2000, that is a 40.94% decline in the S&P 500. But we can't assume that that's as bad as it's going to get, all right? So, again, I've done this before, but I want you guys to understand that if this 2000 level doesn't hold up, and by the way, what we're looking at now is a monthly chart going clear back to 1990, so 1990 to current, and each candlestick represents 1 month of trading in the S&P 500. And when you pull back and look at it on an even longer term chart, you can see that even though, there's a decent amount of trading, right, a couple years of trading in this 2000 plus or minus level, when you look at it on a longer term chart, it just doesn't represent that big of an area. So, this 1500 to 1550 level, which is where we peaked back in 2000 and again in 2007, we cannot rule out a return to that 1500 to 1550 level if this bear market gets bad enough. This is not over by any stretch of the imagination, and so again, it'll be an absolute miracle if we don't get to this 2000 level. I think we hit it, and I think we hit it pretty soon, but we cannot rule out a return to this 1500 to 1550 level on the S&P 500. Now let's take a look at the math behind losses and why it's so important for you to do everything you can to keep your losses as small as possible when the market goes against you. If you lose 20%, it takes 25% to get back to break even. If you lose 33%, now it takes 50% to get back to break even. Guys, do you know how hard it is to make 50% in anything? It generally takes years in the stock market or an individual position, a sector, whatever, to make 50%. Losing 33%, that's super easy. We basically did that in the first month of this bear market in 2020 in the S&P 500. So you can see how quickly you can lose 33%. But making 50% is very hard. Remember that the market takes the stairs up and the express elevator down. Now, if you lose 50%, now it takes 100% to get back to break even. So keeping your losses as small as possible and knowing when to cut losses and taking, it's always tough, right? When you're down 10, 15, or even 20% on something, it's always hard to say, oh man, I need to cut this thing. I get it. It's something we all grapple with, but that is exactly why you need to have a disciplined, non-emotional, fact-based loss cutting and risk management system. My system is simple market signals.